We're recording.
We're starting.
Sounds good.
Recording in progress.
Oh, there we go. Oh, yeah, you gotta mute me.
Okay, good morning, everyone. My name is Kelly Bufink, and I'd like to welcome you to our Strip Matter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation today is titled Market Update. It's presented by Douglas Gimple with Diamond Hill. And for those of you that don't know us, we are Strip Matter Wealth Management Group. We are located in downtown Fort Worth and are a registered investment advisory firm. We specialize in investment management, financial planning, estate planning, and real estate investing. And we've been in business since 2007 and serve clients throughout the United States and the world. A little bit of housekeeping before we get started for all of you. You have access to the chat feature, so if you have any questions, please don't hesitate to type those in, and we'll be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email, so if you miss something, don't panic. You'll have the ability to watch this again. And you're welcome to forward these presentations or any of our presentations to your friends and family if you think it would be beneficial. Now, today's webinar is meant to be purely educational and not meant as tax or legal advice. So please talk to your licensed professional before taking action on any of the information in this presentation. And for more information, including key disclosures, please visit our website at stripmatterwealth.com. I do have a full team of advisors behind me, including Mr. Strip Matter himself and Corey Moravitz, but I am Kelly Bufink. I have been with Strip Matter Wealth since 2018. Prior to that, I was the National Branch Director at First Command Financial Services for a number of years. I have a degree from University of Maryland, University College, and a CFP and a fiduciary, and I specialize in estate planning, retirement planning, investment planning, protection planning, and veteran benefits. But don't let me talk about myself. Let me tell you about our speaker today, and that is Mr. Douglas Gimple. Douglas serves as a senior portfolio specialist for Diamond Hill. He joined the firm back in 2016, but prior to joining Diamond Hill, he was the executive director, senior portfolio manager at JP Morgan Asset Management from 2004 through 2016. Douglas has a Bachelor of Science in Finance from Miami University and a Master of Business Administration from the University of Dayton. He holds his Series 7 and 63 FINRA security licenses. So without further ado, I'm going to hand it off to Douglas.
Thank you very much. Glad to be here. As the slides say, and I guess we'll start jumping into the slides. I'll be looking to my side because that's where there's a giant screen. But this will be a market update. And what's interesting is that we had to put this together ahead of time, obviously. And everything that we've put together is as of March 31st. So quite a bit has happened as soon as the calendar turned over into April. And I'll talk about that as well. But if we'll look at the first slide, we'll just jump into it and talk about kind of what we saw in the first quarter, and then obviously into what is now the second quarter. But volatility, as it says here, was the name of the game. And what you can see on the left is the VIX, which is kind of that measurement of volatility, the S&P 500, and we can see how it was dropping even as we were getting into late March, and really the bouncing around, if you will, that we see both on the equity side and then on the fixed income side. On the right hand, the green line on the right hand is the 10-year Treasury yield. The black line is the MOVE index, which is basically the VIX for fixed income. And it just shows how we were bouncing around day to day, as information was coming out about tariffs. Going back to January, we had DeepSeek AI at the end of the month. And then into February, we had a pretty significant rally, which started to back up. But all of this going on is just telling us that, this year it feels like it's going to be all about that day-to-day move. And, what we're seeing in the markets is that continues as you would expect, given all the news that's come out just in April. But if we look at the next page, here we'll see some of that Treasury yield volatility. And so on the left side, you've got the day-to-day yield shift on the 2-year Treasury. And then you've got on the right side, the day-to-day yield shift on the 10-year Treasury. And we call it the mustard colored days are those that are greater than 7 basis points. And anything green is obviously less than that. And obviously on an absolute basis, up and down. The information that shows at the top of the screen here shows that the 2-year Treasury fluctuated by that 7 basis points or more on 17% of trading days in the first quarter. I looked at that right before I came in, and through yesterday, it's 22% of the trading days. And the 10-year has moved that much or more. Now on there, it says 22% of the trading days. Since the beginning of the year through today or through yesterday, it's 26% of the trading days. And if we look back at the 10-year in 2024, it was roughly 15 to 16% of the trading days. So what that's telling me is that we've seen a lot of movement, knee-jerk reaction from a tweet, from a news report, real or fake, that has really rattled the markets. And what we saw last week, there's no, I don't believe there's hard proof of this, but a lot of discussion around hedge funds unwinding their basis trades, meaning trading the Treasury futures against the actual on-the-run Treasuries, and having to close some of those trades out, which created a significant move higher on the longer end of the curve. And this week we've seen, I guess I'd call it some stability, where we haven't been moving at such a great level. But given the way that it's gone so far this year, I would expect that we'll continue to see more and more of these periods of volatility, whether it's the president this morning coming out and saying, hey, I'm going to get rid of Chairman Powell, and Chairman Powell basically towing the line and not really addressing that, because technically and legally, I don't believe the president can do that, but I'm sure they're going to try and find ways in which they can. But if we move on to the next slide, let's look at some of the things that were really creating that volatility. And as I mentioned earlier, we had DeepSeek AI earlier in January or late January. Inflation reports kind of up and down, and this top chart doesn't really offer a full appreciation for some of the volatility we've seen just in the last 3 months or so, but because it's such a long period of time. But if we were to zoom in on that right side of the chart, you would see, I think we started the year at 3.3% headline CPI, then that dropped, and then it came back up, and then most recently it dropped. But the expectation, which you can see in the bottom left side, consumer expectation for inflation 1 year out has steadily climbed, really from the low point in November at 2.6% to 4.9%. And then the most recent number, which I believe came out last week, 1 year forward expectation for inflation is 7%. So a pretty scary thought that we could see, and this is, again, consumer sentiment, but the impact from tariffs, I think, is widely accepted that it will be inflationary. And continued inflation, when you have steady job growth, or at least a steady labor market, which we'll look at in a little bit, that creates concern about stagflation. That creates concern about what the Fed's next move is going to be, because academically, if you look at increasing inflation and a steady to strong labor market, academically, the Fed should be raising rates to slow inflation, which obviously is not what the White House wants. But I would think that Powell and the rest of the team at the FOMC would focus on the numbers. And so it remains to be seen what direction they're going to take. Their dot plot, which was released in March, was showing 50 basis points of easing, so 25 basis point cuts, 2 of them by the end of the year. We won't get another update on their outlook until June, but the markets have priced through Fed fund futures, which is very difficult to say. They've priced through Fed fund futures as high as a little over 4 25 basis point moves. Now it's down to, I think, 3 1/4 25 basis point moves. So the market is still, envisioning a more accommodating Fed, but it remains to be seen how tariffs flow through to the end consumer. And you see on the bottom right hand side, the consumer sentiment. And this isn't the end all be all, but it is a survey where they're asking consumers what they think and how confident they are. March's number was at, we'll call it basically 58. The more recent number is 50.6. So we're talking about like financial crisis type levels going back to 08. So I think there's a lot of concern about how the tariffs are going to impact every industry, and just the uncertainty around, we put a delay for 90 days and then we're taking it off, and then we're putting on Canada and Mexico, and then we're taking it off, then we're putting it on, and we've got a 90-day window to get trade deals done. And just the constant change is creating a lot of angst in the market. And we can go to the next slide and we'll look at what some of that has done, looking at the investment grade market on the credit side, and then on some of the securitized areas that we work in as well. You can see that on that far right side, and again, it minimizes some of the impact because it's over such a longer period of time. But spreads, so what investors are demanding they get paid above and beyond comparable duration treasuries, has continued to widen out. So if we look at the number at the end of this chart, was about 93.9 basis points over comparable duration treasuries, wider spread, lower prices. And so if we looked at it today, the investment grade credit spread is around 111 basis points. So we've seen some pretty significant widening. And if you look back, just in 2024, so maybe halfway through that chart, pretty stable. We saw some widening that occurred, when we had some fluctuations in August of 2024. If you remember that we had the Japanese yen carry trade unwind in early August, that created kind of a knee-jerk reaction in corporate spreads. Then the rest of the year, the rest of 2024, was, as you can see, spreads coming down, and that delivered some pretty impressive performance. But now we're starting to see that spread widening. So again, ended the quarter at about 94, and just in the last couple of weeks, we're at 111. It's not on here, but if we talk about high yield spreads had been in the, call it the 280s. And now I'm trying to think, in March, they've widened out by 60 basis points. And then in the first week and a half of April, they widened out another 56 basis points. So, high yield spreads are now in the, call it the 420 type range, still well below historic average, but a significant jump from where it had been. And it's all about, pricing in uncertainty and pricing in concerns about rates and where we're headed and the economy overall. If we look at the bottom is showing non-agency securitized. So think of, specifically here, we're looking at the darker line is asset-backed securities. And the scale for that is on the right-hand side. And then the green line is non-agency commercial mortgages. So think of office, industrial, hotels, things of that nature. And we looked at these securitized spreads. And if you look at, the ABS level, they tend to be shorter in duration. So the ABS level was about 60.2 at the end of the quarter. Right now, as of yesterday, 71.4. So a pretty significant move higher just in the last 2 weeks, we'll call it. On the non-agency commercial side, 140.4 is where we ended the quarter. And right now we're closing in on about 160. So, that's really been the story after we moved through March. It's really been the story for the markets in April, has been, again, this volatility, a bit of a flight to quality to a certain degree. Flight to quality means moving into treasuries, but spread sectors, the riskier sectors, have all widened out, and widening out means prices are coming down. So a little bit more challenging performance. But the other side of that is, as spreads are widening out, if you hold those securities, you're going to eventually be getting more yield. So it's kind of that glass half full approach to it. So that's my kind of brief, if you will, market update. Next, I want to talk about, some of the inefficiencies in the marketplace. And, I'll be talking about this just as an opportunity standpoint, not from how we're managing money, but again, as was said in the beginning, more of an educational piece. So, one of the things that we look at in the fixed income markets is, if you're familiar with equities, the S&P 500 is kind of the measuring stick. In fixed income, it's the Bloomberg Aggregate Bond Index. But what's interesting is that there are very specific inclusion rules as to what makes it into this index. And we look at the overall market and compare it to the index, and there's a lot of difference. And that means there's a lot of opportunity to find value. And so the first thing that I'll bring your attention to is at the bottom of the chart in the disclosure, the Securities Industry and Financial Markets Association puts together all of the data about the markets. And unfortunately, they don't update their data very often. And we go out every quarter and we check. But what we see here is December 31st of 2021. So very old numbers, but thematically, things remain the same. So there's still going to be this dislocation between Treasury in the market and Treasury in the index, as well as corporates, as well as mortgage-backed securities, as well as asset-backed securities. So I just wanted to clarify that really quick. Now, if we look at Treasuries, for example, they're the biggest, most liquid part of the market, and there are 22.6 trillion in Treasuries. But the index, as indicated here with the light blue line, only includes about 10.5 trillion. And so it's certain parts of the Treasury market just are not included. So Treasury strips. And a Treasury strip is simply you take the Treasury security that has principal and interest, and you separate out those cash flows into a new security. So you have a principal-only security, an interest-only security. And so to include those in the index would be a double count. That makes sense. But floating rate Treasuries, TIPS, they're not included as well, anything less than a year. So, when we're looking at the market, something like a Treasury strip can offer up a little bit of incremental value compared to kind of nominal Treasuries. So that's some of the dislocation there. On the corporate side, not as much of an opportunity because it is pretty straightforward, but anything that is split rated, meaning that it's triple B by one manager or by one agency and double B by another, won't be included. Anything that's not rated will not be included. On the mortgage-backed side, which is the next group over, mortgages are what I would refer to as probably the second most liquid part of the market behind Treasury, because these are agency mortgages. But that black box covers everything. The blue box, the index, only includes pass-through mortgages. And I won't go into too much detail here because it can get very complex, and I only have a limited amount of time. But collateralized mortgage obligations are mortgages that are differently structured. So a pass-through mortgage has principal and interest every month. You have a pool of mortgages where people are hopefully making their payments. And each month you get principal and interest into the portfolio. If rates are coming down and someone with a 4% mortgage can now refinance into a 2% mortgage, they're going to do that because they're going to save money. And so they essentially pay off their 4% mortgage, get a new 2% mortgage. But the investor that holds that pool of mortgages gets all of that money back, gets the principal all back when rates are, let's say, 2%. They were earning 4%. Now they get money back where they're reinvesting it into the market at 2%. So not where you want to be necessarily. And conversely, if I have that same 4% mortgage and mortgage rates go up to 8%, then I'm never going to refinance my mortgage. I'm going to ride out that 4% as long as I can. And so as an investor, I'm receiving that 4%, but I want to be able to get money and go out and invest at 8%. So it's that prepayment and extension risk, because as rates go higher, the mortgages that are held get longer in life because the chances of a prepayment are pretty slim. Now, there's always kind of what we would call a natural level of prepayment, which is relocations, divorce, death, all these different things that can impact the mortgage market. But what we see, and what we've seen especially now, really since 2022 and the rate reset thanks to the Fed, is prepayments have slowed down immensely. Because, again, I myself, I think it's a 2 5/8% mortgage. I will not refinance, and I'm not moving anytime soon, because it's just almost the pain of selling my house, making money, that's great, but then having to go buy a new house at a 6 or 7% mortgage. And it's what people have referred to as kind of golden handcuffs that keep you from moving on. And so the mortgages, the pass-through mortgages that are part of the index, continue to extend. For example, the mortgage index duration, that sensitivity to interest rates, was as low as 1.6 in August of 2020, when the 10-year was at 53 basis points. Now that the 10-year has moved much higher, 4.25%, 4.5%, the duration, that sensitivity to interest rate for those same mortgages in that part of the market, in that index, their duration is now 6.5. So it just changes the complexity of your investment when you're looking at it. And then lastly, on this page, asset-backed securities. It's a $1.6 trillion market. Only 80 billion, I say only, but only 80 billion is included in the index. And here it's really an issue with types of ABS. So the index will only include autos, credit cards, some equipment, motorcycle securitizations, and device payment plans, which are essentially your cell phones. Does not include any of the new financial innovations since the financial crisis, like consumer unsecured, timeshares, solar panels, property assessed clean energy, diamond securitizations, music royalty catalogs. None of those are included. And then beyond that, other restrictions are rating agencies. And this goes across all the sectors. The index will only look at S&P, Moody's, and Fitch, which on the corporate side is not that big of a deal. But on the securitized side, whether it's ABS or CMBS, commercial mortgages, Kroll and DBRS / Morningstar became much bigger players post-financial crisis in the securitized industry in doing ratings. And so something could be rated AAA by Kroll and or DBRS, but because it's not rated by the big three, S&P, Moody's, and Fitch, it won't be included in the index. And so, in the last change that I have seen to this index was probably now 5 years ago. And it was to expand the ABS inclusion for motorcycles, equipment, and device payments. Moved the allocation of ABS in the index from 0.3% to 0.5%. So still a very small part of the overall market. So we can go to the next page and just provides a little more detail, drilling into treasuries. And you can see here, again, no bills included. There are notes and there are bonds. The majority are notes, and the difference between notes and bonds is just your time to maturity. No tips, no floating rate, no strips. So that's, again, just showing you the exclusion when you're looking at the benchmark, specifically at the treasury market. So if we look at the next slide, that gets into mortgages. And what's interesting here is that I talked about, the pass-through and the CMO difference and the benefits that are available with CMOs, because, or maybe I didn't get into that and I will now, but CMOs, they're very specific cash flows. So you could buy a planned amortization class, which is essentially, it keeps you within a range of prepayment and extension. And it does so by having underlying support tranches. And essentially what that means is that in the environment I used earlier, where rates were coming down, people financing, a lot of money was coming into, mortgage investors when they didn't want that money because they would be reinvesting at lower rates. For a CMO, those support tranches for a PAC bond, those support tranches will absorb a lot of that excess cash flow and keep the PAC bond within a stable range. And conversely, if rates are going higher, you have less money coming in, the support tranche will actually give up cash flow to keep that PAC bond within that certain range. And so you could buy the support tranche knowing that you're going to be picking up more volatility. You can buy the PAC bond knowing that you'll get more stability. But what we tend to see is that because the CMO market is so diverse, tens of thousands of different securities, they trade pretty inefficiently. If we're looking at credit, corporate credit, high yield or investment grade, you can trade that on market access. You can trade that on TradeWeb, where I put out a list of securities and it moves very quickly. And if you're buying the same list of bonds, the same time I am, and we put our lists out, we're going to get pretty comparable pricing and pretty comparable execution. On the mortgage side, there is no electronic trading because there are just too many iterations of different securities, too much bid-ask spread, meaning that what I think a bond is worth is going to be different what you think a bond is worth based on our own assumptions on prepayments, extension, credit risk. And so it's a much more inefficient market. And the inefficiency is really in that CMO space, but also another part of the mortgage market on the non-agency commercial side. So if we look at the non-agency commercial allocation for the benchmark, that is all what are called conduit deals. So conduit deals are 50 to 60 different loans, I would call it plain vanilla, where there's not a lot of surprises. It's comparable to what you would see with a pass-through. What's not included in the index are things that are called single asset, single borrower. So just as they sound, it's a single asset. So the example I always use is a luxury hotel in Maui. That is one asset, and that is the whole deal. And what that allows you to do is it allows you to get a really good understanding of what you own, the risks associated with it, as well as the opportunities. And if you're really lucky, then you can maybe make an on-site visit to the Grand Wailea in Maui. We don't get to do that. But so that single asset, single borrower, again, that can be a trophy property type of hotel. It can be an office building, apartment building, industrial complex. But it gives you that clean look through to really understand everything that you're getting with that deal. The other side of that, single borrower, because it's single asset, single borrower would be something like Motel 6, where you have 100 very similar kind of mid to lower tier hotels and one borrower, that is the corporate entity. And so you can get a pretty good understanding of their financials. You can see everything. You can see where all the hotels in the deal are located. And it gives you, again, that ability to really drill in and understand, well, where is this motel located specifically? And you can look at the surrounding area. But the single asset, single borrower, that's an area that's really taken off even this year from a growth standpoint, because you can get that clearer understanding. And a great example is office. With a single asset, single borrower, we can look at office and say, well, we don't like Class B properties, which is basically A, B, and C is based on how well they're maintained, how modern they are. But we can look at a Class A property that's 90 to 95% occupied, that's gone through a renovation, and but pricing wise has gotten hit because everything related to office has gotten hit. So that's an opportunity where you can look beyond the benchmark and find these securities that from a risk standpoint are very comparable to what's in the index, but the structures are very different. The protections are very different. The other area, non-agency CMBS, that is also not included in the benchmark would be CRE CLOs, so commercial real estate collateralized loan obligations. So people hear CLOs, immediately they think about credit, they think about bank loans, lev loans. That is not what this is. CRE CLOs are essentially bridge loans. They tend to be 5 years, floating rate, and think of it as I own an apartment building. I don't actually own an apartment building, but in the example I do. Own an apartment building and I want to add a pool or an energy efficient air conditioner or a gym. And so I use the collateral that I have in the building to get this loan and essentially upgrade the property. And then I can theoretically increase rents and make more money. So this is an area of the market that's also kind of started up and really seen some growth this year as the CMBS market starts to, I think, find a floor and start to rebound because there's a lot of money on the sidelines. But CRE CLO, as you go from conduit to single asset, single borrower to CRE CLO, you get more and more complex. So CRE CLO, you have fewer number of loans. The structures are a bit more complex, but you get paid for that complexity. You get a little bit more OAS, option adjusted spread, again, what you're earning relative to comparable duration treasuries by dipping down into these areas. And so that's a way where, you know, you can look like the benchmark from that 30,000 foot level, but when you drill down into the underlying, you know, level 2, level 3 type sectors, that's where you can really differentiate. And then the last part on the agency piece, or I'm sorry, on the mortgage piece, is non-agency residential mortgages, which are not included in the index. And that's really, I believe, a result post-financial crisis. Back then, the non-agency resi mortgages were subprime mortgages, which are the bane of every finance person's existence. That was around in 08, 06, 07, 08. But these are parts of the market that have really grown in the last couple of years, specifically in non-agency RMBS. What I'm talking about are ways for homeowners to get access to the equity in their homes. So think about, I've got a home, I've got, let's say, 200 grand in equity. I want to tap that because I'm not going to be refinancing my mortgage to pull that equity out because people were doing that back when rates were incredibly low. And so you can either go get a home equity line of credit, you do that through your bank, through another financial institution. If you're 64 and older, you can get what's called a reverse mortgage, which is essentially, if you have 200,000 in equity, you can pull 50,000 and use that to spend on obviously whatever you want, but your monthly budget doesn't change. You don't have to make any payments. The interest accrues as time goes on and builds up to either, and this is where it gets a little morbid, either the homeowners pass away, they sell the home, or it's no longer their primary residence. So an 80-year-old gets a reverse mortgage, $50,000, they pass away. When they pass away, their estate is settled, the home is sold, and the lender will get 50,000 plus whatever that interest that has accrued. But for the borrower, it doesn't really impact because month to month, they don't have to worry about it. So that's on the non-agency RMBS side. And there's one other that I would mention for those that are not 64 and older. There's home equity investments where if I'm 35 and I've got 100,000 in equity in my home, I can get, let's say, $25,000 and I don't have to make a payment. But what's different than the reverse mortgage is with the home equity investment, the lender actually gets a vested interest in your home, meaning that as the home appreciates, the value of what they've lent to you goes up. So it's a way for them to make money. They're not going to make it immediately, but they'll get, there's a rate that's charged, but then also any appreciation, and there's a ceiling there, but there's also a floor if home prices were to go down. But it's something that it's more recent on the securitized side, and the CFPB just came out a couple of months ago with some comments on it, which we had someone in here on a road show talking about it, and they actually liked the idea that CFPB was looking at it, although I'm not even sure the CFPB exists anymore, but they liked that people were talking about it and disclosing everything so that borrowers would really know what they were getting into. So that's another area of the non-agency RMBS space that is not included in the benchmark, but can offer up some pretty attractive returns at investment grade type ratings. And so that's very important. And one other area, residential transition loans, which are basically your fix and flip loans. And it's not necessarily, Joe Smith who bought a house, he's going to fix it up and then turn around and sell it. It's more, companies that are in the business of doing that. And what's interesting there is that the majority of those were not rated up until this past summer when we had our first rated deal. And now more and more the deals are coming to the market rated. So that will help eventually. But I think early on, you still see some nice spread advantage because of that. So we can get into, and I don't think I have anything. Oh, no, I'm sorry. The next page. I apologize. And ABS. And this is something that I talked about already, but just to get into it a little bit more, the asset-backed securities market, that 1.6 trillion, that includes CLOs. So CLOs from the standpoint of underlying loans are bank loans, lev loans, corporate debt. So that's a corporate exposure, even though they're packaged as ABS. So that's not something that we invest in. That's not something that we really consider. It's not that there's anything wrong with CLOs. It's that the underlying collateral is on the credit side. We don't have that expertise. And what I have said is that clients, prospects don't want us learning how to manage CLOs with their money. So we don't invest there. But it is part of the ABS market. And I would say if we were to hire somebody that does have that expertise, then we would most likely get into that market, but we don't have that based on our background. But if you look at the bottom of that page, and you can see the percent of ABS as of December 31st, 2024. So we're a little bit late here, but it didn't change that much with the end of the first quarter. But you can see it's dominated by autos, about 65% in autos. Credit cards are 24%. Utilities, those are stranded cost utilities. That's a very old funding source for nuclear power plants. The other is what I talked about before. So that's equipment, motorcycles, device payment plans. And then you can see that CLOs are not part of the index inclusion. But again, as I mentioned earlier, the innovations that came out of the financial crisis, consumer unsecured, high-end, what I call high-end student loans, those are pretty big part of the market and just not included in the index. So you could buy consumer unsecured with very similar characteristics as credit card, but you're going to get a little bit more yield because consumer unsecured is not part of the benchmark. ETFs won't be buying it. Some of the larger managers won't be buying it. But it's that opportunity to differentiate and take advantage of, what I would call antiquated rules. High-end student loans. So think of SoFi back in the day. College Avenue is another one where they got together and said, hey, let's look at the student loan market and find, people that went to get, higher end degrees that they can get into and help to refinance their debt. And then SoFi has taken that business model and expanded it into mortgages, has expanded it into consumer unsecured and all these other parts of the market. So that's an area that we think offers some value as well. But really, any of these ABS areas that are not part of the index, they have the same type of credit protections, credit enhancements as these others, but they're just not. They trade a little bit wider from a spread standpoint, a little bit cheaper because they're not part of the index inclusion. So that I know I've got about 20 minutes left, but I'll leave that for questioning. Whether it's about what we've seen so far this year, anything that I've talked about with regards to opportunities outside of the index, I'm all ears.
Yes, thank you so much, Doug. I appreciate that. And if any of you guys have questions, use that chat box. I actually see some dots moving, so we'll wait for those to come in. In the meantime, everyone, thanks for joining us today. And of course, education is extremely important to Strip Matter Wealth. So you can go to our website, stripmatterwealth.com, to see our calendar events that has the full webinar schedule, as well as the future classes we teach here at the local universities. You can even sign up for our market e-newsletters, as well as a monthly retirement e-newsletter. Okay, it looks like we have a few in there. I see 3. So let's see. It says, how is your team navigating the recent market volatility following President Trump's tariff announcements? And I know you mentioned those have bounced back and forth.
Yep. Yeah. So our team, for the most part, so those first, what was that? Liberation Day was August. It was April 2nd. Those subsequent days, and even into the next week, we really weren't doing a lot. And we weren't because things were moving so quickly. And we felt that we were pretty well positioned from a more of a defensive standpoint, had built up some cash, which gives us the opportunity to react and go in and buy if we think there are positions that have weakened. But we saw the spread widening, in, as I mentioned, in credit and in the securitized market, but it wasn't. I mean, we're still well below historic levels, and so for the most part, I'm trying to think of what we did specifically. We added a little bit to treasuries just to keep our duration in line with the benchmark, but we've been much more active this week, as those levels have held with that spread widening that we've seen. But we're not going to have a knee-jerk reaction. We're very much bottom-up security selection. So, if you ask me where the 10-year is going to be, and maybe that's one of the questions, ask me where the 10-year is going to be in 6 months, my answer has always been, I don't know where it's going to be at the end of today. So I certainly don't know where it's going to be at the end of 6 months. So from that standpoint, when I look back on our activity and what we were doing, we really weren't doing a whole lot because we wanted to see how things would shake out, because the market wasn't reacting as it normally would, meaning that, a ton of equity being sold in historic down days in the equity markets, we weren't seeing the up days in the treasury market. At times we were seeing both down. So a lot of uncertainty. We were very comfortable just kind of holding the line and staying where we were at.
Great, thank you. A second question, which we can actually both answer, is this a good time to invest cash in the market?
I will let you go first then.
Yes. Anytime there's a downturn in the market, it is like shopping on sale, is how I always talk about it. You're buying something at a discount. So if you have extra cash, now is a great time. Does that mean it all goes in at once? Well, it depends on how much and where we're putting it. For many of our clients, we'll dollar cost average, meaning we'll take a portion of those cash dollars and invest a little bit every single month over a 6 to 12-month time period, depending on what's happening in the market. Your turn, Doug.
Yeah, no, I agree with that completely. I bought some in my own account, but I obviously went a little too early. But the dollar cost averaging is I think what's most important, and I think over time, or what we see is your asset allocation is what wins out over time. And I think it's hard, right? I mean, it's hard to, you see the Dow down 2,900 points, you see the indices down, 8-9%, and it's a hard step to go out and buy. And, for us, I look back more towards like March and April of 2020, spreads completely blew out. And just the uncertainty, you want to be buying, but at the same time, you're a little worried. But I think, to your point, if you're dollar cost averaging, whether it's fixed income, whether it's equity, I think it will, I know in the long run, you'll benefit from that. And you can't worry about the day to day that I bought at the wrong time, or because it's already passed. And so, yes, I think now is a good time to be invested, but I would also caveat that by saying it's investor dependent. I am going to be investing very differently than my father is going to be investing. My son will be investing very differently than either of us are investing. So I think that plays into it as well.
Definitely. And this next question relates to what you were talking about with the housing a little bit earlier.
Yeah.
Because we've come a long way from having that 0% interest environment with low mortgages, like you had said, which greatly benefit the income investor. And they are hurtful for someone looking to borrow money. So for first-time homeowners and people who are looking to move, like you talked about, what do you see those mortgage rates looking like and setting in over the next several years?
Yeah, that's a tough one. I mean, I put that with trying to predict where the 10-year is going to be.
Yeah.
I mean, theoretically, if we just take a step back and think about it, academically, if tariffs are inflationary and that causes rates to move higher on the longer end, then, mortgage rates are going to go higher in lockstep pretty much. And, the Fed can come out and lower rates, but the Fed lowers rates on the shorter end. They don't impact the longer end directly. So whether it's another QE or they find some kind of financial machinations to lower rates, it feels like, again, and the other caveat being that we move forward with these tariffs and they stay in place for a while, that would indicate to me higher rates on the horizon, but anything can happen. I mean, we could eliminate all the tariffs tomorrow. I would say that's not probable, but given how things have gone, who knows? But I would imagine there's a greater chance of rates going higher than there are of long end rates coming down anytime soon.
Okay. Well, thank you for that. That looks
Yeah.
like it's the last question in our queue. So everybody, thank you so much for joining us today. And if you don't already have somebody to work with, you have learned a little bit about these market trends. I would highly recommend you take the next step towards your own financial success. You are actually eligible to scan that QR code on the screen and request a complimentary consultation with one of us advisors. But again, this will be emailed out to anyone. You are welcome to share it. Douglas, thank you so much for your time today.
Thank you very much. I appreciate it.
Yes, sir. Y'all have a great day.
You as well.
Bye-bye.